Welcome to TheoTrade. This is Don Kaufman. January 4th, 2023. We're just seconds after the cash close here on the second trading day of the year. S&Ps is just downright wild. I mean, we were everywhere today. We sold off. We had rallied. Volatility once again is just bleeding through. Of course, we had the FOMC minutes come out, and hey, are you feeling the wrath of the Fed in this one? So, hey, let me begin with the fact that yes, the S&Ps closed up some 28 handles, which we saw kind of a blistering rally into the close. But you can hear in my voice, I'm like, a little bit of a rally into the close. This is about as dangerous as trade can get, right? So we'll talk about the Fed minutes in just a moment. There's really not that much on that particular front, other than the Fed just sounds downright hostile and is talking about a recession. Okay, push that aside. There are some wild divergences inside of trade right now. Okay, internals of the marketplace are completely fractured. And again, this, provides what I believe is some incredibly dangerous trade, especially on an intraday basis. Let me actually begin with a little bit of a breakdown of the tape, okay, kind of after the close and why you really need to pay attention, again, specifically on an intraday basis. The first thing that I want to point out, yeah, the S&Ps are up. Nasdaq only up about, 0.5%. Obviously, we're going to point fingers towards Microsoft. Microsoft receives downgrade, gets absolutely pummeled. The stock is down 4.4%, but it's well off some of the intraday lows, hitting 225, closing again 229.14. It's well off those intraday lows. So that provided for a weaker Nasdaq. However, at the exact same time, you had a few products that are probably in oversold conditions that are bouncing back. Of course, you're going to bring up Tesla in here. It's up some 5%. Nvidia, which is getting smoked lately, it's up by 3%. Apple, okay, Apple was the stock that took the big hit yesterday, bounced by 1%, even Netflix to the upside. The problem with all of that, it's just not good enough. It's just not good enough, and it's fracturing the market internals. You realize that at points today, you actually had 90 stocks trading to the upside in the S&P 100. We closed with 80 stocks to the upside. It didn't make any difference whatsoever. We're at this weird, place where, again, Google now is diverging lower. I mean, again, Google is actually threatening some of recent lows. If you take a look at Amazon, this thing is just horrendous. Like, these are not in good shape by any stretch of the imagination. And one of the things that is very misleading is, again, throughout the course of the day, the ticks were strong, they were positive. The advanced decline line, when I'm talking about ticks, I'm actually talking about like quantix in here. Right? Almost all the ticks were positive throughout the course of the day. Again, the advanced decline line was stellar, okay? But it's all for nothing. And I'm serious about that. It's all for nothing. It doesn't matter what some of the market internals happen to be right now. As I said, it's very much a fractured marketplace because you have these mega market caps that few of them are in oversold territory and bouncing. A few of them maybe just have not had the beating that they need to take yet and are threatening to head a little bit lower. Again, Microsoft, it's in pretty rough shape. In fact, if you open up like a 5-year on here, okay, that is a slippery slope that we're presently on. Trading at the 225 level or below could be a considerable break from there. It's an easy drop down to the 200 handle inside of Microsoft. Nevertheless, Amazon is even more disconcerting on this particular front, that facing like the 80 level could be really absolute make or break in the near term for the entire marketplace. Now, push that aside for a second. So we're talking about fractured market internals, but I want to show you something even more fractured than that, okay? And it happens to be energy. Taking a look at energy, absolutely got hammered yesterday. If we bring this up in auto expected moves has actually had the option marketplace to pick forward risk. So this is where the week started, the upper edge of the expected move, lower edge of the expected move. So yesterday, the energy markets get smoked. Okay, today the energy markets, they got smoked to the open, rallied back up. They're finishing almost unchanged. You're like, well, why do you care, man? They're unchanged. I'll tell you exactly why I care. Take a look at oil. Oil's down almost 5%. Okay, the energy marketplace is critical. I mean, energy was, by far and away the top performer last year. We were looking for a rotation of sell side activity of energy early on this year. And what's so interesting about it is you did not get that today. You didn't get it. Like, this marketplace feels like it wants to go higher. I'm saying not just energy. I'm saying the entire S&P feels like it wants to go higher, but it's being held back. But you can't look away from the fact that Microsoft is down 4%. Okay. Energy, again, it just didn't participate in the rally, but at the same time, on a day-to-day basis, and the reason I'm bringing up energy, you come in, you look at the screen on a day-to-day basis prior to the market open, you should pay careful attention to energy, because if it's down, it is next to impossible for the S&Ps to actually burst into a rally. Remember, energy just, 2 years ago was minuscule in the S&P 500 in terms of an overall sector. Energy now, well, everything else fell flat on its face. So energy means a lot more, especially with the Exxon Mobils and the Chevrons out there rivaling now most of your major tech stocks in terms of market capitalization. Okay, so we talked a little bit about market internals being fractured. We talked about the energy divergence, which is wild when you see oil down 5% and energy massively unchanged. We looked at Microsoft as being a drag in the S&Ps. Now, let's actually go back over to the Fed. One of the things that I thought was quite interesting. Obviously, the Fed minutes, they came out. This is Mountain Standard Time, but for the most part at noon Mountain Standard Time, Fed minutes came out. The initial reaction was a very negative one. It's what I call feeling the wrath of the Fed. Listen, the Fed didn't in those minutes have anything like new to say other than recession is plausible, and they did not care about that. They also talked about the return, of, for instance, two-sided markets, which implies a lot of volatility. They were okay with that. The other thing they actually mentioned was slowing, the pace of rate increases, which is about as far away from a pivot as you can possibly get. Pivot would actually indicate, hey, we're not going to raise rates, we're going to lower rates. They're not even considering it. Okay, they're considering a recession as being okay. They're considering, again, slowing the raises, slowing the hikes out there, but it's as far from a pivot as you can possibly get. And again, you got to be careful at this point because, as I said, feeling the wrath of the Fed speakers are going to be everywhere for the next 2 weeks. So we're going to get a lot of Fed speak. It's going to be a lot more volatility in this marketplace. And that's why I caution you, okay, if you're not feeling the wrath of the Fed right now, you're going to in the next 2 weeks. Not to mention the fact that on Friday morning, it's the employment situation. We got a situation, it's employment, and here it comes. Okay, last but definitely not least in here, you got to look at the SPX because there's one very key takeaway from all of this. This is a shortened holiday week of trade. We're looking for about an $84 expected move, right? And again, I'll reiterate, that just means $84 to the upside or $84 to the downside. What have we moved so far? Absolutely nothing. So strap in because the remainder of this week, which is just Thursday, Friday, we're going to turn into, once again, Mr. Toad's wild ride in this marketplace. And again, if you look at the S&Ps today, look at the range. We traded basically close to 3,900 all the way down to 38, 38, 36. So, what's the difference? 60, 70 point ranges in the marketplace. For the remainder of the week, though, we're looking for this $84 move higher, $84 move lower. I'd suggest get ready to rumble. The other aspect that really, really resonates with me is if you look back, I believe this is 11 trading sessions. We've done absolutely nothing. It's chop, it's fast, broken, it's disconnected trade, especially today. I mean, that's the only way to actually, really describe today's trade. It's fast, broken, it's sketchy. It's just downright sketchy. I mean, look at some of these 1 minute candles. Now, obviously, this is as people were reading the FOMC minutes, but even before that, right into the cash open today, okay? Talk about a little violence inside of your trade. That's on an ISM manufacturing number, okay? These are, put on your big boy pants because we are moving. Contract size is also, it's really picked up, obviously coming out of the holiday weeks, but we're up to 1.8 million contracts. Listen, get ready for this marketplace to rock. There's not a great feel right now. I'm not going to sit here and preach to you that you have any feel for the marketplace better than I do because I don't have one. Okay, you can look at all the MACDs and the Fibonacci's. There is no question that big tech kind of feels heavily oversold. I would agree with that. Okay, you're seeing the rally in Tesla. You're seeing the rally in Nvidia. Okay, I would also think to myself, like, hey, you know, the financials have been the outperformer. I would expect the financials are actually going to come in a little bit, meaning some sell side inside of the financials. But the market as a whole, okay, just feels like it wants to head a little higher right now. Okay, but the conversation piece in the days to come, it's not going to be about a feel. This is going to be about order flow. And order flow right now, as I said, it's broken, it's disconnected. You got days where, you know, oil's down 5% with energy basically, look at this, massively unchanged, literally down a penny on the trading session. Okay, it's beyond a conversation piece. This is what volatility is made of. All right, you're gonna have to sit back and let this range over the last 11 days kind of relinquish itself. Let it kind of play out to the upside. To the upside, there's no question. You got 39.32, and it's a hop, skip, and a jump away. You hit 39.32, that's your rally point, right? To the downside, once again, we head into the volatility box, the abyss. Anything under 3,800, all of a sudden is a quick, precipitous drop into the 3,600, right? We'd be right back into the volatility box. There is no clean trade right now. There's nothing but volatility. All of us are going to feel the wrath of the Fed. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.